What's going on, guys? Welcome back to another video. In this video, I've got another very important AMC update to bring all of you this evening. So what we're going to be covering in this update are some of the things that a lot of people have been asking questions about over the last couple of days, specifically with these cost to borrow changes that we have been seeing, especially since the Fed has just raised the federal funds rate. Now, in addition to this, there's also a new rule, essentially a new rate that is going up, and it has to do with failure to delivers in the treasury market and in the mortgage-backed securities market. That fee for failing to deliver is actually going up based on the federal funds rate being increased. So there's a lot of things that we need to go over here. We have a lot of important AMC updates to cover, so I don't want to waste any more time. So before we get into all of that information, if you enjoyed the information and analysis that I provide for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. And again, guys, a lot of people are finding so much success with that 1348 trading strategy. If you do want to learn more about it, get access to all of the alerts on 350 plus stocks on the 3-minute, 15-minute, 30-minute, 1 hour, 4 hour, and daily timeframes on stocks and cryptos, access to all of the 8 private live streams every single month. Make sure you check out that link to the Discord down below in the description. So AMC right now is down a little bit in the after hours. GME just put out their earnings. The market's not really reacting overly positively at the current time that I'm recording, but they did say that their NFT marketplace should be up and running by the end of the second quarter of 2022 this year. There's a couple of other things that are important about that time frame, but we might get into that a little bit later. Now, coming over to some of these Ortex updates right here, we're seeing a lot of very, very good things kind of starting to develop. Now, I know a lot of people don't really trust this Ortex data, but we do have to look at the trends on what's happened in the past and what is happening right now. So again, we're seeing 100% utilization, but I don't necessarily believe that at all right now. What I'm more paying attention to is the number of shares on loan. We are now up to 134.27 million. We are climbing up pretty steadily here. And again, cost to borrow is slightly lagging. Now on this chart right here, they're listing the cost to borrow as 1.25%. But as we can see over here, the cost to borrow has been steadily increasing over the last couple of days. Remember, we've seen that 1.47 number on the average for a while. It's now switched to the minimum. We're seeing 2.01%. Now, if we continue to see these shares on loan continue to go up, yes, there is going to be more shorting, but we get to the point where the cost to borrow starts to rise so much that it doesn't make sense anymore for these shorts to keep holding onto their basically position. They've kind of been shorting it since November once we saw that new variant news come out, when honestly, we were primed for another run. It is very possible that we've kind of skipped that potential cyclical nature of the January run, and we're just kind of waiting for the next one to kind of filter in. But what we're looking for here is the cost to borrow to get up to those higher levels. We have 2.01% right here. We want to see it get up a little bit higher, but as we all know by now, AMC and GME tend to move together. We have AMC's estimated short interest rate here at 21.17%. When we come over to GameStop right here, it's 21.31% with an average of 8.26% cost to borrow and 11.95% max. That is very, very significant, and it doesn't really show any signs of slowing down. The shares on loan continuously increasing. The short interest continually increasing. The cost to borrow is steadily increasing. Last week, we were seeing GME's average cost to borrow at 3. That is a very significant increase. And if you are a short, again, these are variable rates right here. So if you're shorting the stock paying a 3% cost to borrow, now it's jumping up to 8. Well, that's a very significant difference in what you have to pay. And that is not something that these shorts really want to deal with. It honestly creates a little bit of a headache for them, especially if they're up so much on their position. If the stocks are just going to stay stagnant around these levels, which again, when we come back over to the chart of AMC specifically and kind of take a look at this on the 4 hour, remember, we were talking about this in the live stream today. Why haven't the shorts kind of come out and tried to use all of those shares that they have on loan? Well, we've come down to these lower levels around 12, 13, or 1350 in the past. We bounce right back up, come back down, we bounce right back up. Then we kind of teeter around, try to get above this 200 EMA, we get dropped back down to around 14, bounce right back up. So what the shorts are most most likely looking for here is for a significant confirmation of a further drop. I don't necessarily think that we are going to get that right now. It's possible, but if we were to see that, we would see a lot of shares then get unloaded, more shares go out on loan, and then a further increase in the cost to borrow. And again, the true utilization is really unknown right now. Remember, we've talked about that Notre Dame report a couple of times in the past, where stocks with over 75% utilization have a 1 in 26 chance every single day of basically seeing a forced share recall by the lenders of those securities. If we continue to see this behavior in AMC and GameStop and all of these shares going out on loan, we could be in for a potential run over the next couple of months. But again, guys, these things are going to take time. This video isn't really meant to just kind of come out and say, oh, we're going to run right now. Not necessarily, but what this is for is to kind of look at the data and say, well, things are looking really good right now. They're developing in the right direction. And I want kind of everybody to be prepared for when these things start to happen. Now, a lot of people have been asking the question of whether or not the Fed raising the federal funds rate is going to be influencing and increasing the cost to borrow on AMC, GME, and any other stock lending program. Now, when we come over to this piece by the DTCC right here, we can see today's announcement, which was yesterday by the Federal Reserve Bank to raise the Fed funds rate by 25 basis points will result in a change in the TMPG fail charge for failures to deliver processing effective the close of the FedWire securities settlement on Thursday, March 17th. Beginning at this time, settlement obligation fails will be charged at the amended rate. U.S. Treasuries and agencies, 2.75%. Mortgage-backed securities, 1.75%. So they're increasing the rate that these institutions have to pay if they fail to deliver. That's very interesting. Then when we come over here to this article right here, here's what the Fed rate hike means for borrowers, savers, and homeowners. I know we've gone over this a couple of times in the past, but I want to give you guys an actual source for what rate hikes actually do to the everyday person. So what we're going to see here is borrowing gets more expensive, mortgage rates go up, home prices end up coming down. A lot of people are going to be paying a little bit more on their mortgage if they have an adjustable rate or if they are going to be going to get a new mortgage right now. But if you have a fixed rate on your mortgage right now, you're going to be just fine. Then coming down a little bit more, we have home equity lines of credit are going to be going up as well. Credit card debt, if you have any credit card debt, that is going to be going up as well. The APR that you're going to be paying on that goes up. So you can see here that they're kind of disincentivizing people from borrowing money. Now, how do they do that? Well, they increase the interest rate. And a lot of these things are pegged to the 10-year treasury. That's kind of why a lot of these different interest rates are going up, even though the federal funds rate isn't directly affecting consumers. So then it brings the question, well, since a lot of these banks are the ones issuing these loans for some of these mortgages, some of them might be doing some car loans, some of these home equity lines of credit. These same banking institutions are the same ones that are essentially sending out all these shares on loan and determining these cost to borrow rates. Now, in order to kind of figure out what the cost to borrow rate actually is or what it should be, it has to do with supply and demand, which is where we kind of talk about utilization a lot. But again, if you're looking at essentially what happens when the Fed increases rates, well, a lot of these different interest rates on a variety of things start to go up. I actually asked this question to somebody in the industry. And again, we talk about people in the industry all the time that if they don't have direct expertise on these short squeeze situations or shorting stocks or having basically direct experience with some of these big firms, they may not know exactly what's going on. The response that I got was, I'm not sure if it will, but it should. And that's kind of the conclusion that I'm coming to here. We are already seeing these cost to borrow numbers start to increase the day after the Fed is increasing interest rates. Now, we're going to have to wait and see if this is going to continue to go up, but this is like the first time in 3 years that the Fed has done this. If we can continue to see these cost to borrow rates go up, it's kind of going to disincentivize a lot of shorting. And since the market has kind of already priced in a lot of these interest rate hikes, we are going to see more. We could end up getting a 50 basis point hike at some point over the next year. But if we continue to see these slow increments of 25 basis point hikes going into the end of 2022, that kind of takes a lot of uncertainty out of the market, allowing for a lot of that money on the sidelines to start flowing back in, meaning that it doesn't make a whole lot of sense to short a lot of things right now, especially if the cost of borrows are going to be going up. So that is going to wrap up this update on AMC. If you enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening, and I'll see you guys in the next video.